Hey, welcome back, traders. It's John at Rain King LLC. It's Thursday, April 18th. It's about 6 p.m. Eastern. I'm recording this on Thursday night as I'll be out of touch traveling tomorrow. So let's get into the markets. So as a reminder, this presentation is for educational purposes only through Rain King LLC. The agenda is to get into the indices, the market breadth, and then we're going to take a look at some market tools and talk about tools we use, and then we'll wrap up. So just a quick reminder, if you're interested at all in Rain King Insights, just send me an email to support@rainkinginsights.com. Now, let's get into the market. Let's take a look at the indices this week, as it's been a sell-off week. So this is the NASDAQ composite. I just cut this at the close. Just wanted to recap, over the past 5 to 6 weeks, we've been noting in these videos the distribution that's been occurring under the surface and the bad pattern of net new lows. So, we've been talking about this for a while. There were multiple tweets that I was making along the way about stall days and expectation breakers that we saw when the market tried to rally and move higher and failed. The action just wasn't right. Even as these air pockets, I refer to them, they seem to be kind of concerning. We were starting to see situations where the market would gap open on the open and then it would reverse. Those are all really negative signs. A kind of a dark cloud was building. And then, as I tweeted out on Monday, all those little fingers in the dam finally broke loose. And the market now is, got to pull back in full motion now. Now, the little lines in this chart, this teal line is actually a number of NASDAQ stocks that are above the 50-day moving average. We are way down, only 18% are above the 50-day moving average. And those are levels we haven't seen since way back over here, which was the October lows. So the market internally on the NASDAQ is very weak. The lower chart here in teal, this is the NASDAQ above the 5-day moving average, much shorter term. And you can see that this I believe we reached 7 or 8%, which was an extremely low level. We haven't had that for a long, long time. It's actually off this chart. The last time we were around the 10% level was, again, the October lows. So it's possible that with this extreme reading that we might get a little bounce or a rally attempt. And this is the new highs, new lows. You can see new lows are expanding, confirming all the breakdowns that were really starting to affect the market for the past 4 to 6 weeks. Now it's becoming just obvious and we're correcting. Here's a quick look at the S&P. This was the stronger of the indexes. It was holding up the longest. But even this unhealthy pattern of gap opens and reversals continues as we correct. We're right down now sitting on the 5,000 psychological level. That might be support. I wouldn't be surprised if we dip below it and kind of dance with it a little bit. It is possible that we could come down to this support level here, which would be further approaching more of a correction, which I define as 8% to 12% of a correction. So this area would be in the 8 to 9%, meaning maybe we have 2 waves down, but we'll see how it plays out. But the NASDAQ is certainly the weaker of the 2 indexes, and the S&P is following and correcting as well. So let's move to a segment I'm calling Market Tools. Now, I thought it'd be interesting to talk about this because, we had the November follow-through day, and we had a good 3 to 4 month rally, and now we're correcting. And so it's a good time to look at your tools. When we experience market with character change, and we're going from a strong uptrend that started in November, and we're now pulling back, and maybe it goes deeper into more of a correction. It's interesting to look at your tools and actually, believe it or not, do a post-analysis of the tools that you're using. Are they working as you intended? Are those tools flagging signs of a weak market early, or are they too late? Were you getting the clues that you should start reducing your exposure in your weaker stocks and gradually have been moving to cash? We certainly in these videos have been using distribution days. We use the 20-day moving average. The power trend was on for quite a long time, so we used that as well. But it's a good time to look at your tools. You see some of the tools that I use, but let's dig into this a little deeper. You know that I use new highs and new lows quite a bit. I look at the action of the leading stocks. They're usually the first sign of things weakening. I use that Excel spreadsheet. Exposure levels. In these videos, I've been putting out exposure levels, ranges, and I've been basically guiding people down the last 4 to 6 weeks. So every person, has different time frames. So you use different tools, different indicators. I'm not advocating for any of the tools that I use. I've just used them for a long time, and they seem to work well for my time frame. But you got to find out what works for you. Keep it simple is what I'd recommend, but really trust the two indicators that you use. If you have too many, they're going to conflict with each other, and you'll just get confused. So these are the pool of indicators that I typically use, and I do trust them. So one of the tools that I know IBD uses and a lot of people use is really the power trend tool. So I want to take a quick look at the power trend. The power trend tool is really helpful. It's great at getting you in early in the trend. If you got a market that's really strong coming out of the gate from a follow-through day, it helps you get more aggressive and take on more exposure quicker. So it's really good at that, getting you into establishing a trend. I think it's also pretty decent when you're coming back through smaller pullbacks and mild corrections. But the power trend tool, though, I think is if you experience a major market top, the power trend is going to be late in getting you out. If the market goes into a kind of a vertical violation where it has a very sharp drop down to the 50-day moving average, the power trend's not going to help you with reducing your exposure quick enough. So I think, no one tool is good for everything. So the power trend probably needs to be used in conjunction with a whole bunch of other tools to get a good read on the market. So I called up a couple power trend charts we'll look at to expand on this. So this is the power trend from 1982 to 83, a very strong power trend. I won't go over all the rules, but you can pause your video player and look at all the rules. Generally, a power trend is when we're above the 20-day moving average for at least 10 days. And as long as this pink line stays above the 50-day, which is the red line, basically the power trend is still on. There's some nuances to it, but that's the basic message. So in this case, the power trend turned on here in September of 1982, and it was a super strong trend for 210 trading days. It wasn't till way over here in July of 83 that you can see we closed below the 50-day moving average, and the pink line is crossed below the red. So that's when the power trend officially turned off. So it worked well, because you can see here it got you out, or at least had you reducing your exposure, and the market continued to correct. So here's another example where the power trend did not get you out of the market early. This is a strong power trend, 1999 November, and it was a strong trend up until April 7th of 2000. Same rules, but you can see here that in November, the power trend turned on right here, and it was about 103 trading days, very strong. In this particular chart, the purple line is the 20-day. So you can see, but the problem with the power trend in this situation, this was the major top in March of 2000, the dot-com bust. So the market really got volatile, sharp correction. You can see here that the market's sliced right through the 50-day moving average, yet the 20-day moving average was still above the 50. Now, there is something called the circuit breaker rule, and that's described over here. But the circuit breaker basically is just that. In a sharp break of the market, if you come 10% off the top in a very short amount of time, this can help be a trigger to say, start reducing your exposure quickly. You can see if you followed the basic rule, the power trend didn't really turn off until after you had this sharp panic selling. We had a rally, and then finally the purple line crosses the officially turned the power trend off here. You really needed the circuit breaker rule because it was too late. So just understanding the tools and how effective they are in different market conditions can be really helpful. So I wanted to show you one more market tool. This is really called the window of opportunity, WOO. Now, this was created by Steve Sweats. Now, Steve Sweats is an excellent can slimmer, extremely experienced trader. He's a good friend. And he came up with his rules for the window of opportunity. Now, it's specifically designed to have faster signals than follow-through days. So it gets you in a little faster, and it also gets you out a little faster. And it's got all these specific rules, and a lot of them trigger off the 21 EMA. And so one day he actually described all these rules in a presentation at Blue Sky, I think it was Blue Sky 2. And what I did as an architect, I made a picture out of the rules. So I'm going to share that with you. So here is a diagram of the window of opportunity, the WOO rules. And I've turned Steve's rules into this diagram. So I'll take you through it. It's a busy diagram, but it's not that complicated. So let's take the NASDAQ, and we're going to look at the NASDAQ in three situations: a correction of 4 to 8%, a correction of 8 to 15%, and a correction of 15% plus. So when you get a correction, now Steve defines a correction as when the NASDAQ climbs from high to low, a minimum of 4% is how he defines a correction. The NASDAQ will be making a 20-day new low, and the MMTS signal turns red. So MMTS is over here, and essentially, I won't read this. You can pause your video player, but basically it's when the 10-day and 21-day are crossing each other and a certain number of days above. So you might want to read this if you really want to understand the MMT model to understand what a signal of yellow, red, and green are. But for this video, I'm just going to continue. When you get a correction of 4 to 8%, there's two situations. One, you get that correction with the 50-day is still on top or above the 200-day. So when you have the 50-day above the 200-day, in order to get back into the market, you have to have you have a choice of three conditions. We either get a follow-through day, which is defined here, or you have to have what Steve calls a green day. And a green day is defined here, which is essentially when the MMTS model turns to green, which is defined here, or he has what you call a buy day. And the blue buy day, I won't get into this, you can read it. These are the rules that establish a buy day. You get any of those signals, basically the window of opportunity says you can start buying a stock or two. If in the 4 to 8% correction, we have the 200-day moving average above the 50, the conditions say we need a follow-through day or a green day. And again, 8 to 15% corrections, you can see here, the 50 days above the 200-day, you need a follow-through day or a green day. And if your 200-day is in the reverse position and it fails, the follow-through day fails, you're eventually going to need, if you have a failed follow-through day, you're going to have a follow-through day and a green day, both conditions in order when you're coming out of a deeper correction. And if you're coming out of a 15+ deep correction, again, Steve wants to see a follow-through day and a green day. So the MMTS model needs to be green as well as follow-through day conditions. So this is another way to look at the market in terms of when do I get back into the market. The WOO rules are really good by Steve, and they are a little faster than using something like the power trend or other techniques. So what I did in trying to do a little post-analysis on my tools, and I wanted to look at exposure levels. As you know, in these videos, at the end of the video, I always give a range, 10 to 20, 40 to 60. So I went back to all of those and found the midpoint of all the exposure levels that I was recommending in the videos. And I said, okay, how did it do in this particular cycle? And I used the cycle from the correction that started in July. We had the 3 waves down to the October lows. Then we had the follow-through day. And how did it work? How did my exposure levels work in the rally? And then when we got into this yellow zone, which we started to see distribution and some stalling action, how did my read of the market go? So then I just drew, here are the exposure levels. This line in green is 100% exposure. The red line is 0% exposure. And I literally just plotted what I've been saying in these videos. So back when July, when the market was peaking, we were at 65%. And then as we were getting signals that a correction was brewing, we were down to 50, went down to 15. And then we got into the second leg of the correction in September. We were down to 5. And then if you recall, we had a little follow-through day in late September, and exposure levels were going back up. So we're being flexible. The market was giving us a follow-through day. So we got back in a little bit. But then that follow-through day quickly rolled over, and exposure levels, I brought them back down to 5%. And then we got the follow-through day, and here's how it played out. We were at around 5% when we started. We got up to the 15% level, almost 20% level a week or two into the rally. And then as things really started to work, ramped up exposure up into the 70% level, and eventually got the exposure up to about 80% in December, where it stayed there for the month of December. And then eventually, when we got some signals in early February that the market was really taking on some water, you can see I was bringing exposure levels from 70 down to 50 to 40. And then it was a little bit of a rally. We're trying to hang in there, got to 60, down to 30, 15. And last week I was recommending an average of 10% exposure. So when I look back at this and I say to myself, well, how did these exposure levels are coming out of my tools that I've showed you before. So I'm saying, how did they hold up? How did they work? I think generally I'm pleased with how they kept my exposure levels. I think in this area here, when we were at 80%, I was holding back a little bit. I was hoping we were going to have a little correction, and then the market internals would be strong so we could get up to 100% or even on margin. But the market kind of just didn't give us, the internal market did not give us strong signals that the market was healthy. And so probably I would say maybe the exposure level could have been more in December and January. But so that's something I can take a look at my tools deeper to see if that's something I can improve upon. But I like the way my tools, even though the market was making new highs, I let my tools tell me how to bring my exposure level down. And I was pretty happy with how this played out. So it's good to look at your tools and do post analysis, particularly if you're mostly in cash now. So let's wrap up. So where's the market? Well, we certainly were at a pullback. We've pulled back about 5%. If we get down to the 8%, I call that a correction. It's certainly all in motion right now. The S&P might get some support at the 5,000 level, but it might go deeper. We don't know. A lot of uncertainty with interest rates, the Fed, as well as Middle East situations. So we're below the 20-day moving average. The trend is down. Net new lows are greater than 50, so that's a negative sign. So nothing's really doing well because we're correcting. Everything, the leading stocks are correcting. They're building bases. Exposure levels, I believe should be 0 to 10%. And really the 10% might be that one stock that you're trying to hold through a base that you want to try and play out for a bigger move. But clearly the trend is down. But what's important, it was when the trend is correcting, is stay engaged with the market. Watch the action daily because you want to be prepared. Run your relative strength screens, find the stocks that are holding up the best, and we're going to start looking for change of trend. So we'll cover that in future videos as it unfolds. We don't know where this is going to go yet, but that's the summary for the week. So the quote of the week is from George Soros. He says, the sad part is that as much money and brain hours that go into predicting the market, it's a completely unnecessary activity in achieving success in the market. Trading is about probabilities and risk management, not about predictions. So we don't need to predict what's going on. We just need to use our market tools to observe the market and trust our tools to help us with exposure levels and when we should be aggressive and when we should be much more defensive. We certainly should be in a defensive mood and be that way until we see more evidence that maybe the correction has played out. That's the general market update for a special Thursday edition. I won't be around on Friday. We'll see how the market does. And I look forward to everybody having a wonderful weekend, and we'll see you next week.